All right, guys, so we're back with Ask a CPA, here to answer all of your tax questions. I've got my co-host here with me, Brett Phillips. How are you doing today, Brett?
Doing great. Russell, how are you, man? Good to see you.
Yeah, you too. Living the dream over here, getting ready for tax season to start up.
My favorite season of the year.
No
Some people
doubt.
like winter, some people like summer. I like tax season.
Like tax season. It is a good time of year to make money, but it is not a great time of year to sleep.
Hey, sleep's overrated, man. You sleep when you're dead. I'm ready to go. I'm ready to get into it. Tax season's great. I love getting in front of clients that I normally don't talk to very often. You might see them once or twice a year. So connecting back with clients and, getting an update on kind of where everybody's been, getting an update on where people's kids are. It's fun to kind of catch up with everybody that you've had, these clients that I've had for 15 years, and so it's fun to kind of catch up with them and see where they are in life and what's been going on.
Yeah. And it's, kind of in this kind of post-COVID world, tax season is one of the only times a year that people come into the office, and so it sounds kind of weird, but I love people coming into the office, get to sit down with people and talk about their businesses and ththings like that. I think you're probably a lot like me, and we got into this and we like doing this kind of work, not because we love the tax code, but because, we really enjoy hearing about ways that people make money. And there are so many ways out there to make money. And so every year I get blown away by some weird story, like somebody's doing this or doing that. And you're like, how much money did you make doing that again?
Yeah. We had a client this year who started a little private equity or a little hedge fund that just does baseball cards, and they'll buy trucks or big lots of baseball cards, and they'll store them and sit on them, and it's like an investment. And they do really, really well with it because they can buy them at the right price, and then hopefully they appreciate in value, or there's some really good cards in there, and they can sell them above what they paid for them. And it's wild. I have a client who's a financial advisor, and he's really into, memorabilia and the old baseball cards. And he was like, hey, there's a card show. We were talking about this at a happy hour.
Yeah.
He's like, there's a card show coming up, right by your house. You want to go to it? And I was like, heck yeah, man, let's go. It's gonna be a blast. It was so much fun. It was this huge auditorium, and all these tables and cards were set up, and you kind of walk around and kind of haggle with people and negotiate, try to get better prices on cards. And it was really fun. It really brought me back to growing up, and we were huge into card collecting back in the day. So it was fun.
Well, if I told my 14-year-old that you could, make a living card collecting on baseball cards, right? He'd be like, there's no way I'm going to college. But, forget that.
Yeah. Get him into it now. Maybe he won't need to go to college if he can flip some cards.
Yeah. That'd be great. Well, we've got some questions here today from our site here, askacpa.co. So if you haven't been over there, be sure you check that site out, submit your questions, and we really do answer these questions on the spot here. So
absolutely. Yeah, we've been getting a lot of questions lately. A lot of people are submitting questions. We really appreciate that. It's fantastic. Yeah, we've been getting a lot of influx of questions, so that's great. And comments on videos and everything else.
Yeah.
So yeah, feel free to reach out, subscribe. Yeah, leave comments. Let us know what you think. Things you like, things you don't like. Let us know.
Yeah. Well, you ready to jump in here to our first one?
Yeah, let's do it.
Let's do it. So we've got Melissa from Columbus, Ohio. So I'm paying for my daughter's college tuition. I've heard there are tax credits or deductions I might qualify. What are my best options to save on taxes?
Yeah, this is a great one. So, kind of high level, there's two tax credits. So there's the American Opportunity Tax Credit, which gives you $2,500 per student for qualified expenses. And you can claim this. This is for your first 4 years. So your undergrad, you can claim the American Opportunity Tax Credit, and you get 40% of the credit up to $1,000 is going to be refundable. The second one is the Lifetime Learning Credit, and that provides you with a $1,000 tax credit, which is 20% of the first $10,000 of tuition expenses, but there's no limit on this one. So if you're in graduate school, or hey, it takes you 5 or 6 years, sometimes 7 years to graduate, you can still take the lifetime learning credit even if you're beyond that 4 years of undergrad. So yeah, those are the two main tax credits for college tuition. Also consider if your kids are going to college, or you have young children and you're planning on them going to college, consider a 529 savings plan. That's a great way to start putting money away now. It grows tax deferred and can help pay for college expenses. What do you guys see over at your firm there, Russell?
Yeah, I mean, so you covered it. You hit all the hot spots, but I would say that something that a lot of people overlook when they're self-preparing their tax returns is that, if you have a kid that has a part-time job, even if it's just a summer job, something like that, and you're a high-income earner, it's better to even push that credit down to your kid, right? Because sometimes that, a good portion of that credit's refundable. And so it's not as much of a credit for sure, and that their tax rate's not as high, that sort of thing, but it's better than losing the credit altogether, right? And so with the way that the child tax credit now, or while they're in school, and if you're still a dependent, it's only $500. You're going to lose that. But if you can get the tuition credit when you wouldn't otherwise be able to, sometimes it's better to toss the kids' return in there. So that's one thing that we see people overlook a lot when they're doing it by themselves.
Right. And those income limits are about $80,000. It goes up a little bit, but about $80,000 for single filers, about $160 for married filing joints. So if your AGI exceeds that amount, you're probably not going to get benefit for these tax credits. You'd be better off letting your kids, take those credits if they qualify and they have earned income as well.
Yeah, that's right. So the other thing that, you mentioned the 529 plans, and something that we counsel a lot of business owners on, so especially if you're a sole proprietor setup, is the whole pay your kids strategy, right? So it's a great way. You pay your kids, and then they can take that money, put it into a Roth. You get the tax deduction, they put it into a Roth, and then you can pull out those contributions to a Roth tax-free and use them for college. So you can't do the growth, right? So that growth money is still stuck there, but all of those hard contributions that you already got a deduction on, that you got a deduction on your business, kids didn't have to pay income tax on it. So that's tax-free money, but you can pull that tax-free money out and use that for college as well.
Right. Love it. That's a good one, man. So let's jump into the next question. So Robert from Austin, Texas. Robert asks, I'm planning to sell my business in the next year. How can I structure the sale to minimize capital gains taxes, and what should I watch out for? Russell, you got a lot of M&A experience. What do you think here?
Yeah, so you want to bring in a professional pretty early on. There's some gotchas when they structure the contracts for these things, right?
Right, for sure.
And if you're selling your business, not many people sell businesses more than once. So if you're fortunate enough to sell it once and sell it big, you really need to make sure you got a professional in there. The big difference is if it's an equity transaction or an asset transaction, right? So if they're buying just the assets, or they're buying all the equity. And, if they're buying the equity, that's great for you. It's rare that happens, because if they buy the equity, they're buying all those liabilities. But if they do that, right now, you're straight capital gains treatment for almost all of it. There's some exceptions to that, but almost all of it's going to be capital gains treatment. But if they're buying the assets, so that's where now there's a lot of negotiation that goes on here, because you got to separate those assets between assets that are going to be tax ordinary income. So like your fixed assets, depreciation recapture, some, valuing AR, those kinds of things, versus the goodwill portion of that sale, which that's going to be long-term capital gains, which is great. But, the devil's always in the details. And what the IRS has come up and said, look, y'all have kind of opposing views, because the buyer, they want as much money pumped into equipment so they can depreciate that faster, versus goodwill where it's longer. So they're going to push for that. You're going to push for more goodwill. The IRS says, hey, y'all are going to fight this out, and we're going to stay out of it. So whatever you do, you both have to report the same numbers. And but in the negotiation, it's pretty easy to kind of value those assets really high, or and if I'm usually representing the seller in these cases, right? So we're always trying to push the value of these down. We're like, hey, like the fair market value of this piece of junk, truck and equipment. It's like nothing, right? But the seller's like, no, that's high quality stuff, right? So that needs to be valued real high. But so you kind of have that push back and forth, but that's where you can make a lot of gains on the tax savings is by talking to a professional early and making sure that you're putting this sort of language into the LOI, and then you're making sure that language gets into that APA on the back end. What about you? You see any of these things? You do some M&A too?
Yeah, we do a lot of M&A, and you're right. Yeah, for a stock sale, especially if it's structured as a C corporation. So if you set this thing up, with the intention of eventually selling it, there's a tax code called 1202, which is qualified small business stock. And as long as you have original issued shares and you've held them for at least 5 years and you sell that stock, it has to be a stock sale. It couldn't be an asset sale. You sell that stock, you can exclude up to 100% of the capital gains up to about $10 million, or I believe 10 times your original basis in those shares. So whichever is greater. So you can exclude, a huge portion of that transaction if you do a stock sale versus an asset sale. But you're probably going to take a little bit of a haircut on the valuation of the business because the buyer, of course, wants to do an asset sale. They want to take that depreciation. And when we ever do a purchase price allocation, we're always looking at, hey, let's try to allocate, if we're on the buyer side, we want to allocate as much to the fixed assets as we can because we want to take accelerated depreciation on that. We want to write those assets down quickly versus goodwill, which is amortized over 15 years. So yeah, you're exactly right. That's always like the first kind of negotiated tactic is whether we're doing an asset sale or a stock sale. And if you're not a C corp, you're probably still open to an asset sale because you probably get a little bit of higher valuation. What else is there?
Well, sorry, go ahead.
Yeah, you could also consider an installment sale. So an installment sale may spread that sale out over a few years. You spread your basis out over those years as well, but you could, potentially, try to spread out that sale over multiple years, and then you can, look at your other personal investments and try to harvest some losses in your personal investments to try to offset some of those capital gains in future years. You could also look at charitable contributions. Typically whenever we see a seller business and they're charitably inclined, we're looking at setting up maybe a charitable remainder trust or a donor advised fund or something to put a big portion of those shares or of those sales proceeds into some kind of fund that allows them to make charitable contributions and not have to recognize or pay taxes on that portion of the sales proceeds.
Yeah. I've seen a lot of DAFs lately. The process has gotten a little bit easier to do. There's some, several kind of companies that do that now, kind of specialize in it. And so the process has gotten a lot easier. And, I like what you said there about spreading the installment sales, spreading those capital gains out. If it's something where you can spread these capital gains out to keep yourself in that 15% tax bracket versus the 20%, it's 5% savings right there on the full amount of long-term capital gains, And so if you're going to do that, you're usually going to collect some interest, that sort of thing. So charge a market rate, probably a little bit of above market rate. And that's also going to help push your valuation up because your sell terms are going to be a lot more favorable to the buyer in that situation. They're going to have to take on as much bank debt. And so you're probably going to put some upward pressure on that valuation and save that 5%. So that was a good one there. The installment sale.
Buyers love that as well because it really gives your business this level of credibility that the owner is willing to kind of seller finance the business, right? So if you say, okay, you can pay out the purchase price over 5 years, or you can, 10-year note or something, it really, even with like a 5-year with a balloon payment at the end or something, it gives the buyer confidence that this business is going to continue to grow and scale and isn't like, that they're not getting ripped off if the seller still has some skin in the game and they're willing to kind of finance the deal, or even if it's a portion of the deal. It gives the buyer a lot more confidence in the transaction, I think.
Yeah, absolutely. I think that also with the probability of some tax rule coming in play, so this whole argument or fight over how much goes to equipment and how much goes to goodwill, buyers are going to be much more inclined to want to push more in that equipment bucket, especially if 100% bonus depreciation comes back, right? That's a huge one, especially that first year cash flow, first year tax break is a big one.
Yeah, I think we'll probably see a lot of kind of slow down until we get really good clarification on what the proposed tax legislation changes are going to look like. I was at a meeting this morning, and they were talking about QSBS, the Qualified Small Business Stock, the 1202, where you're allowed to exclude up to $10 million of capital gains. They said that's a big factor that could be up for change, over in this new legislation. That's one of the items that they think they're really going to try to go after. But who knows? I mean, whenever there's tax reform, I mean, everything is up for grabs, and nobody knows what's going to come out of it. So it's hard. It makes our job a little more difficult. It's hard to plan for. It's hard to prepare our clients for. But
yeah. I've already told my wife, right, we're going to tone down the summertime vacations, because I fully expect to be reading over tax rule after tax code as the different proposals start coming in, kind of waves in the negotiations, right? So,
hey, you can read it from the beach, man. Why read that in your office?
Well, next time we're going to have to talk a little bit more about the beach there and getting that vacation rental, because I think that with the tax code changing, right, this could be a great year to finally take the leap and get that vacation rental on the beach.
That's right. Come on down to Florida, man. We're renting and ready to go. Yeah, if you're looking for a beach rental, I'll leave the link down below.
It's a nice one.
Yeah. Come check it out.
Yeah, you just got some snow there, right?
Yeah, unbelievable. It's so wild. It snows there like every 10 or 20 years. But yeah, seeing the beach with snow all over it and the roads, I mean, it's wild. Those guys don't know. I saw a video of these guys sitting in the back of a truck, like manually throwing salt out of the back of the truck, out of like bags. Like they have no machines for this. Like they're not prepared at all. Yeah, it's pretty funny. But yeah, they got a little snow. Yeah, I'm sure it shut down the whole city. I was supposed to go down there this weekend for an HOA meeting, but it doesn't look like I'm gonna be able to make it. So maybe in the next couple of weeks.
Yeah.
But, cool, man. Well, this was a great one. You got anything else, Russell?
I don't. Just, make sure that you're hitting that like and subscribe button. And if you have questions, be sure and put them out there. We love answering them. This is a lot of fun for us.
Yeah, absolutely. So those were great questions. Thanks, Melissa and Robert. Yeah, we went over college tuition deductions and how to structure something, get ready for selling your business. So this was a great episode. I think we killed it, Russell. We're becoming podcast pros.
I mean, we're the next Joe Rogan, right?
Our numbers are right up there, man.
We're getting so much closer. All right. Well, until next time, Brett.
All right. Thanks, Russell. See you, buddy.
Bye.